Hi, Mark Sturdy here with a brief extract from our weekly analysis, our survey of major world markets in 3 time frames. And this, I thought I'd concentrate this week on bonds. Our broad point is that these markets are in a consolidation phase, and they're notable for reluctance, with they've demonstrated, to retrace to much lower yields. So on balance, they look set to test recent high yields. Let's just look at the 10-year note here. Here's the head and shoulders reversal that established the change from the long-term trend from the 1980s. And this reversal was, you can see that in most of the bond charts. So here it's particularly obvious in this yield chart in the TNotes. So that's what drove the yields up. And they got to about 4%, which also happens to be a Fibonacci retracement of this whole collapse in yields from the 80s. And also clearly a horizontal resistance from prior price action in the 2000s. But since then, since that very quick bull trend in yields, the market's tried to retrace. Notable, though, we think, that the market's tried once, twice, quite emphatically to break the 3.5% level of yields and has clearly failed. So that there's a limited appetite for retracement of the rise in yields from 0.5% to over 4%. And in fact, if we look at the price chart of the 10-year note, this is the March futures contract, we can see that the attempt to go lower yield once, twice, 3 times above 15, higher price, of course, lower yields, has forced a return to check the bottom of this trading range, which is about 12 and a quarter. Were this trading range to break, we think that would signal certainly a retest of the recent highs from October, high yields, and probably higher. Let's see what happens.